Hello ladies and gents, I'm Lex and today we are talking about a topic that's very close to my own heart, and that is, can a car be an investment? Fancy intro, huh? I'm a professional YouTuber now. Anyway, back to the topic. Can a car be an investment? The short answer is no. The long answer is maybe. And I will explain what I mean in the next few minutes. I'm a car enthusiast. I love cars, and people like me, we like to rationalize in any way we can to justify our next automotive purchase. It's a passion, it's an obsession, and I know some of you out there are just looking for that single reason to go and get your next car. But let's look at it objectively. Most cars are complete money pits. And the main expense that you will have owning a car, contrary to popular belief, is not fuel or maintenance, but rather depreciation. For most cars, depreciation is the number one expense that you will have throughout the lifetime of the car. Now, if you are really smart about the cars that you pick, you can minimize the cost of fuel, maintenance, and depreciation, and thus making sure that the car that you pick and you enjoy will cost you the least amount possible. However, if you choose to buy a classic car such as my Mercedes 560, then for sure your biggest cost will be maintenance and repairs rather than the depreciation, since those cars have pretty much almost reached their lowest price. The same applies to any car which is relatively old, say 15 to 20 years or more. Most of those cars have already pretty much depreciated fully. However, you will have much bigger costs when it comes to doing all the repairs and replacing any parts that might break. Now, if you buy a new car, your costs of fuel and maintenance would be relatively low, but for the sake of this video, I want to focus on the main factor, and that is depreciation. Now, if you buy a new car, you're likely going to use 30 to 50% in the first year of ownership. And this is especially true for luxury brands, especially the Germans from Audi, BMW, and Mercedes. And this is less so true for more regular cars, and especially Japanese cars like Honda, Toyota, Kia, or whatever. Now, it's very, very, very difficult to call a car an investment, especially because probably less than 5% of all the cars in the market actually have some price appreciation in general. And most cars that have significant price appreciation are pretty much unobtainable for regular people. And I'm talking cars like the Carrera GT, the Ferrari F40, Ferrari Enzo, and generally limited editions of supercar brands like McLaren, Lamborghini, Porsche, etc. Those cars obviously are not attainable for most people, but unfortunately those are the main models and brands that tend to appreciate significantly. So therefore, most cars are depreciating assets. Now, obviously you can own assets such as stocks, a business, or your home, which tend to appreciate over time and have generally a very solid history of price appreciation. But cars, on the other hand, go the other direction, and therefore they depreciate. And again, with depreciation, you also have the costs of fuel and maintenance, which further drag you down and is pretty much the equivalent of setting your cash on fire. So therefore, if you want to look at investment vehicles, don't look at cars, but rather look at stocks, ETFs, crypto, real estate, any other asset class which has a good history of price appreciation. And I will give you an example later on in the video of why you should do that. Most people need a car, and some people just really want them really badly because it makes them feel all warm and tingly inside, like myself. So I will give you a few tips on how to avoid losing money on your next car purchase. number one, pick a vehicle make or model which you believe will have significant value within the enthusiast niche within the next few years. This guarantees that your car will at the very least retain its value and not depreciate any further. And a good example of that is one of my own cars, and that is the BMW 1M Coupe. That car I bought back in 2014, and since then the car has appreciated significantly in value, and therefore basically means that I have a free car because all the money that I spent maintaining, driving it, etc. is covered by the price appreciation that the car has done since then. Obviously, if I start to account for inflation, this is probably not the case, but anyway, on paper I did not lose any value from that car, and that is a very good thing. Obviously, there are a lot of cars with very strong enthusiast markets from brands such as Alfa, BMW, Porsche, or whatever. Even something as relatively affordable as a Mazda Miata has a very high potential to retain its value and not depreciate any further, which will help you to save a ton of money. Number two, if you want to buy a relatively new model which still will depreciate, it's better off to buy something used, which is either 1 or 2 years old, has a few kilometers on it, but will save you 30% off of list price or more, depending on the car, and thus will guarantee that later on, after when you go on to sell it, you won't be losing 50 or 60% of the value. Rather, you will be losing 20 because somebody already lost the 30 before you. An example of that is my C-Class, which I drive daily, which I bought for 30% off of list price, and despite that it was indistinguishable from new. Now, when I move on to sell that car, I will obviously lose a little bit of money, but not as much if I had bought it new. Number three, financing in Europe and in most places is still relatively cheap, so it's better off that you buy your car with someone else's money rather than your own money. It's because when you have, for example, $50,000 to spend on a car, instead of putting all that money in a car, which, like I said, is a depreciating asset, you can take out a financing loan and instead only put down $20,000, and the other 30 you can invest in the stock market, invest in a property, invest in gold, whatever you want to invest in, just invest it in something else. And that will make sure that at least part of the money that you have is working towards building you more income rather than being locked into a depreciating asset. As it stands, car interest payments are about 4%, while inflation is 7%. So essentially, you are getting paid to use other people's money, and it makes a lot of sense to finance a vehicle in the current economic conditions. Obviously, please do not finance a vehicle which you cannot cover the monthly payments. The monthly payment for the vehicle that you're financing should be no more than 30% of your monthly income. This is so you have a financial reserve and you are not overextending yourself on a car payment. As I said, guys, some cars can be an investment, and I want to show you here on my screen how to evaluate that investment, if it's good or not, by giving you a bit of a comparison. So let's hop onto the screen here and look at the numbers. Okay, so we have two exemplary investment grade vehicles such as the Ferrari F40 and the Porsche Carrera GT, which have seen significant price appreciation over the last 10 to 12 years. In 2010, a Ferrari F40 cost roughly 450,000 euros and a Carrera GT cost roughly 350,000 euros. In today's market, the lowest price that I could find for an F40 is 1.5 million euros. And the lowest price which I could find for a Carrera GT is 900,000 euros. That means that for the 12 years you have profited 1,050,000 euros for the F40 and 550,000 euros for the Carrera GT, or a appreciation of 233% cumulatively for the F40 and 157% cumulatively for the Carrera GT. Obviously, those are some pretty good numbers, and if you have invested in one of those cars, you would have been really happy for holding it on for 12 years. But there is a caveat. Let us compare the gains of the stock market during that same period. So we'll compare the S&P 500 and the more conservative Dow Jones. For that same period, with dividends reinvested, the S&P 500 made a 422% gain. So that is almost double of what the F40 did. And the Dow Jones made 357% gain with dividends reinvested. Therefore, if you had invested that 450,000 euros into the S&P 500 in 2010 instead of the Ferrari F40, you would have made almost double, which is 1.9 million euros on your initial investment rather than having put that money in the F40. We can see very clearly, while these are investment grade vehicles, they still did not perform as well as the wider stock market did, and therefore investing in an index fund is a much better investment than buying a car like this. Even if you had the money, obviously, because very few people do. So my advice is, don't look at buying cars, even cars as crazy as the CGT and the F40, as investments because there are way better investments out there. Look at them as a way to enjoy your passion and lose less money, or potentially just gain a little bit, or at least retain its value. Because if you factor in maintenance, fuel, having to store the car, insurance, and all the other expenses, then for sure you will be losing money. But you can be smart about it and lose a lot less money than most people when they buy a new car. And therefore, you can enjoy your passion, you can go drive, you can modify, you can do whatever you want with your car, you can have fun, but you can do it in a really smart way, which will help you protect your capital, protect your finances, and ensure your long-term plan. So guys, I hope that this data and video has been useful and interesting for you, and I hope when you go on to buy your next car, you will be a lot smarter about it and you will follow the tips which I outlined in the video. Be smart, enjoy more, enjoy longer. That's it for this video. I hope you have enjoyed. Please give me a like for the YouTube algorithm and for me to know that you appreciate this kind of videos, and I will see you next time. Bye bye.